Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Credit crunch is defined as a sharp reduction in the availability of loans for economic agents like households and businesses. Depending on the extent of the reduction in loans, the unavailability of credit can be referred to as credit tightening, credit squeeze, credit crunch, and eventually a credit crisis. Banks or other lending institutions where credit origination takes place tend to tighten their lending for several reasons. These include a rise of non-performing loans at banks, the central bank increasing restrictions on lending, banks' assessment of the economy pointing to a bleak outlook with fall in collateral values, and increased perception of risk regarding the solvency of other banks within the banking system. In recent months and quarters, various surveys pointed to banks tightening credit standards and increasing number of small businesses reporting unavailability of credit. Banking sector stresses in the US and Europe did not help the situation. Against this backdrop, some market observers have been linking the ongoing credit tightening to banking sector stresses and have been calling for a severe credit crunch to occur. We would note that the cyclical credit tightening was underway even before the failure of the Silicon Valley Bank. To take an objective assessment of the situation, let's look at a couple of data points. First, the Senior Loan Officer Opinion Survey on Bank Lending Practices is one of the most followed surveys in the US. This survey released last week did point to US banks reporting tighter credit standards across commercial and consumer sectors during Q1 2023, but did not signal a more significant credit crunch. Instead, the results of the survey looked more like a continuity of the tightening from fourth quarter of last year. To that extent, the results of the survey were much better than what most economists projected. Further, one should bear in mind that bank lending accounts for only 40% of the total credit creation in the US. More high-frequency data on assets and liabilities of commercial banks in the United States, called H8, is also helpful. The latest data released on May 12th showed that we're not in the middle of a credit crunch. Loans at commercial banks increased. Loans and leases in bank credit rose at both large and small banks during recent weeks. In terms of bank balance sheets too, there is little in the data to suggest bad outcomes for banks. Total assets are stable at large commercial banks as well as their smaller counterparts. While we're not suggesting that we are out of the woods yet, we think calling the present situation a credit crunch or a credit crisis is simply overstating the situation. At least the current data does not support this. Of course, focusing on potential weak links does indeed help. Here, we see softness in bank lending concentrated in the commercial and industrial sector and commercial real estate sector. For instance, over the last 13 weeks, loans to the commercial and industrial sector are down 3.9% and 14.1% on an annualized basis at large and small banks respectively. Turning to commercial real estate, loans secured by multifamily properties remain strong but are weaker in other subsectors. Elsewhere, consumer and residential mortgage lending remains strong too. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. This is Kishore Muktinutalapati signing off.